Welcome to today's explainer. It's August 24, 2026, and we are stripping away the market noise. We're looking strictly at the underlying mechanics of global asset pricing. The overriding theme we're seeing today: severe divergence. We're tracking a massive structural tension between highly restrictive real yields and these seriously overextended equity valuations. So let's dive right into the hard data that's going to drive your capital allocation over the next 24 hours. Here is our agenda for today. We'll cover macro sentiment and treasury, equity market microstructure, sector rotation and alpha, institutional insight and geopolitics, our strategic action plan, and finally, the final verdict. Let's get to it. Section 1. Macro sentiment and treasury. The market has officially crossed a psychological inflection point. We are firmly in a bad is bad regime. Now, you might remember when weak economic data was just seen as fuel for Fed rate cuts? Well, that pricing model has completely inverted. Today, weak data is being ruthlessly priced in as impending credit stress. It's actually giving us distinct parallels to the 1970s stagflation, where persistent inflation totally handcuffed central banks, even as growth slowed down. And we saw this exact tension on full display at Jackson Hole. Fed Chair Kevin Warsh explicitly refused to provide any forward guidance. He essentially stripped the market of its usual policy safety net, which forces asset managers, forces us, to trade the raw data. So let's deconstruct the headline inflation numbers using the underlying Fred series data. Core CPI is currently running at 2.6%, but you have to look under the hood. The shelter index is elevated at 3.3%, and services, excluding energy, is sitting at a sticky 2.9%. We're also closely tracking the persistence in used cars and trucks. These specific subcomponents are mathematically preventing the Fed from stepping in to bail out any sudden equity contractions. And this persistent inflation is severely straining the bond market. The 10-year Treasury yield is sitting precisely at 4.714%. With the 2-year yield at 4.245%, we're looking at a positive spread of exactly plus 0.469%. Now, why does this matter? Because this specific curve shape fundamentally alters bank profitability models. It's signaling a structural, long-term shift in the real interest rate premium. The era of free capital is over, and your duration risk needs to be recalibrated immediately. Moving over to currencies, the US dollar index, the DXY, is currently mapped at 98.93. We need to trace the cause and effect chain here. At this specific elevated level, the dollar acts like a massive liquidity vacuum. It aggressively pulls capital right out of emerging markets and global risk assets. This effectively tightens global financial conditions, completely regardless of what domestic central banks try to do. Section 2. Equity market microstructure. The crucial data point here is the extreme divergence in market breadth. While the S&P 500 is attempting to hold its ground, we have to look beneath the surface. The Russell 2000 closed exactly at 2,996.3. That's a daily decline of negative 0.71%. This stark underperformance in small caps confirms a strict, undeniable contraction in risk appetite, one that the top-heavy headline indices are basically just masking right now. To collaborate this risk contraction, we look straight at the credit markets. The high-yield OAS spread is sitting precisely at 2.70%, which is a minor daily tightening of negative 0.05%. But make no mistake. At these levels, we interpret this metric as a direct proxy for underlying corporate credit stress. There is a glaring mismatch right now between equity market complacency and the actual cost of default risk being priced into high-yield bonds. Which brings us to the mechanics of the gamma trap. How exactly are these headline indices staying afloat? The answer is in the derivatives market, specifically 0 days to expiration or 0 DTE options. Algorithmic dealer hedging is creating a mechanical feedback loop that artificially suppresses volatility. We see this with the VIX currently pinned at 15.13. This gamma effect forces market concentration into just a handful of mega-cap tech stocks, leaving us with a highly brittle market structure that's incredibly vulnerable to a sudden liquidity shock. Section 3. Sector rotation and alpha. Let's analyze the snapshot data across all 11 GICS sectors to see exactly where the capital is flowing. Technology, XLK, is taking the brunt of the hit, down 1.79%. Industrials, XLI, is down 0.70%, and energy, XLE, is down 0.80%. Conversely, defensive and real asset allocations are absorbing that fleeing capital. Consumer staples, XLP, showed major defensive strength, up 1.68%. Financials, XLF, gained 1.25%,
Utilities, XLU, jumped 1.02%, and communication services, XLC, is up 0.84%. Even real estate, XLRE, is up 0.58%, alongside slight gains in materials, XLB, at positive 0.07%, healthcare, XLV, at positive 0.03%, and consumer discretionary, XLY, at positive 0.23%. The math is absolutely clear here. Smart money is aggressively rotating out of high-duration tech.
Looking at commodities, WTI crude is quoted exactly at $86.48 per barrel, up positive 0.44 on the day. Now, this isn't just a price point on a screen. It's a critical leading indicator. At $86.48, crude functions as a structural input cost risk. It's threatening to trigger a secondary inflation wave that would completely obliterate any remaining dovish rate cut models you might have.
Next, we track the ultimate institutional risk-off hedge. Gold futures are quoted exactly at $4,707.90, up an impressive 1.81%. Furthermore, Goldman Sachs projections indicate that aggressive call option buying could create a feedback loop that pushes spot prices well beyond $4,900. This is definitive, hard proof of institutional capital fleeing to safety.
In parallel, we have to isolate the digital asset space. Bitcoin is priced exactly at $78,756.56, registering a positive 1.29% daily change. Operating entirely independently from traditional equities, this specific price action reflects Bitcoin functioning as a highly sensitive liquidity proxy. Right now, it's acting as a complex countersignal to the traditional risk-off mechanics we're seeing in the bond and gold markets.
Section 4. Institutional Insight and Geopolitics.
We're also mapping the economic consequences of the escalating US-Canada trade dispute. We're looking at a stark disparity. 0% Canadian tariffs on inbound goods are now being met with proposed 250% retaliatory US tariffs on Canadian dairy products. This isn't just political noise. This is a quantifiable source of intense supply chain friction. It forces immediate recalculations of cross-border corporate profit margins, especially in the northern states. Furthermore, we have to factor in the economic timeline of the pressure campaign against Iran. The Iranian rial has collapsed to an unprecedented 3 million to $1. In response, a U.S. naval blockade in the Strait of Hormuz has severely disrupted transit. Now, while crossings are up 400% recently due to escorted convoys, they still remain down a staggering 90% from pre-war levels. The market is currently pricing in severe tail risks for global energy routing, which directly supports those elevated WTI crude levels we noted earlier. Section 5. Strategic Action Plan. Based on this data, we operate on two probabilities. Scenario A, a bullish continuation, mathematically requires a sustained megacap tech breakout and a yielding steeper treasury curve. If those exact conditions hit, portfolios should overweight selective equities. However, Scenario B, a bearish reversal, is highly probable. This will be triggered by any CPI reacceleration or a sudden widening of high-yield spreads. Under Scenario B, our strict directive is to immediately underweight duration-sensitive assets and aggressively overweight defensive commodities. And as always, we must identify the ultimate blind spot. The most critically underpriced tail risk in the market today is a collision event, the intersection of U.S. fiscal debt issuance constraints meeting a sudden, localized energy shock stemming from the Middle East blockade. If both of these trigger simultaneously, standard risk parity models will absolutely fail. Section 6. The final verdict. Our final rating for today is cautiously bearish, which demands an immediate shift into capital preservation mode. The internal market structure is demonstrably weak, largely due to that severe breadth divergence we saw between the S&P and the Russell 2000. Based entirely on the hard data, this environment demands elevated cash positions and the aggressive deployment of specific defensive sector hedges. We'll leave you with one cold, piercing question that you must answer before tomorrow's opening bell. Is your portfolio's duration risk adequately hedged against a structural 5% terminal rate? If the answer is no, your risk parity rebalancing execution is already behind the curve. Analyze the data, adjust your models, and execute. Thanks for tuning in to today's Explainer.